Hey everyone, my name's Andy. I'm from the Finding Value Finance channel. Today I have with me Patrick and Kevin from North Star Bad Charts. We're going to talk about kind of what they're seeing in a big picture view. The weighted evidence approach is what they use, and that's the same approach that I use. So I'm going to kind of throw the question out there. What are you seeing in the markets today? What is the evidence kind of suggesting or pointing to with the charts that you're seeing?
Hey, that's a big question. It's not looking good, is it, Andy? Good to be on your show again. Great to see you again, by the way.
Yep.
Yeah, the charts are and have been for a while now showing some pretty concerning stuff. I think we've probably both been talking about this for quite some time now, and I know a lot of analysts have been picking up on some of the warning signs and indicators and starting to put together just where all of this is pointing over the last 12 months or so. I can share my screen and show you some of the things that we're seeing. I'm just trying the screen sharing at the moment, so you'll have to let me know if you can see my screen. Yep. So you can see a I'm hoping you can see a picture of me and Pat there. Is that about right?
Yes, that is what we see.
Okay, good stuff. Right. Well, you don't want to look at that for too long, but just quickly to remind everybody that this weight of evidence that you mentioned before, when we're forecasting the future, you always start off with what you know about the current moment in time. You have to carefully analyze and assess everything that you know about the current conditions. You then apply some kind of predictive model to what to try and predict what it is you're trying to predict. So those of you that don't know me, my background and career is in forecasting the weather for 34 years and using scientific techniques to project what we know now about the Earth's atmosphere and try and predict what it's going to be doing next week, next month, next year, or in 50 or 100 years time. These techniques are exactly the same techniques that we use in technical analysis. So you can take a chart of something like temperature or the price of Bitcoin or the price of gold, and you can project into the future. And what you have to be honest about is the fact that there are a range of possible outcomes for the future. If you're talking about the temperature, then it can range between the absolute lowest temperature you can possibly get in your location to the absolute highest you can get. Or if you're talking about the price of Bitcoin, it's anything from 0 to infinity, probably. So there's a huge range of outcomes. And if you're talking about gold or energy or whatever it happens to be, oil, there's a range of outcomes, and each one of those possible outcomes has a probability assigned to it. So you can start to project a week into the future, a month, a year into the future. So a couple of things to take away from that. One is that you have a range of possible outcomes, and the other thing to bear in mind is that the further ahead you're projecting into the future, the more uncertain things become. It's something called chaos theory. So as you go further and further into the future, more and more things can happen on your path to your projected outcome that can throw you off course. So as an analyst, if you're trying to predict what's going to happen a year from now, a lot of things can happen between now and then. So the key thing to do once you've identified your forecast and your most likely outcome is to spot when you're wandering off that path, when your prediction starts to become less likely. And that's how we can use technical analysis to keep us one step ahead of the game. Now, just what you're talking about a moment ago, some of the charts that we're looking at, and I'm just going to rattle through these because it's a bit of a scary bunch of charts, but I think maybe the best way to do it is just to quickly go through them, and then we can sort of talk about them and sort of try and pick out the bones from it and try and work out what it all means. But US government debt, I think everyone knows that for quite a long time now, it's been parabolic and is rising in a very unsustainable manner. A parabola is inherently unstable and unsustainable. That means that it cannot continue forever because the process that's taking place to form that parabola will break down at some point and it will collapse. Okay, you can't sustain something that just goes on to infinity. It always reaches an end and then collapses. So that's US government debt. We're looking here at US Consumer Prices Index. The CPI is doing the same thing. Over time, year over year, CPI going up and up and up, and that's purchasing power going down and down and down. It's another way of looking at the fact that the US dollar, the British pound, the euro, all of these currencies are inflating away to infinity, or flipping it the other way around. What you can buy with your $1, €1, £1 is getting smaller and smaller at an ever increasing rate. This is the currency in circulation. You can also look at M2, M1, all that kind of stuff. It's a measure of the amount of well, US dollars or whatever it happens to be that are in general circulation. And this also is parabolic. So it's another way of representing the same thing. And it's going, in fact, it's more than parabolic, because the red arrow on that graph is a parabolic curve, and the actual currency in circulation graph is going up more steeply than that. So if it were possible, it's parabolic and then a bit more at the moment. Natural gas futures. This is something that we've been looking at quite a lot just recently, not just in the UK, but across in Holland, in Germany, in France, in all the European nations, the United States. US natural gas now starting to pick up, I notice, and these natural gas prices are just, I'm running out of words to describe this, Andy. I can't actually put into sensible terminology. This looks like a meme stock. It looks like some kind of bizarre cryptocurrency that's just sort of going off the top of the chart. But this is natural gas. This is the stuff that we use to heat our homes here in the European Union, in the EU, where I live and around the world. This is used for heating, it's used for energy, it's used in industry. And this kind of rise from a base of somewhere around 20, 30, 40 euros per unit, all the way up to where we are now, approaching 250 to 300. I mean, you're talking about rises of hundreds and hundreds of percent, approaching 1,000%. UK electricity futures, another example of how unsustainable energy price rises have become. The average UK consumer is now being crippled by their energy bills, and I know this with first-hand experience. Here in the UK, the average energy bill a year or so ago was £1,200 a year. That's for the gas and the electricity to heat our homes and power all the stuff that we need in our homes. That's currently heading towards £3,000 a year, with an increase happening in the next couple of weeks. So the price cap, they call it a price cap, that the energy suppliers can charge the average consumer, is being raised. So the average cost for the consumer, the price per unit of gas and electricity, is going up again. That's going to take it to approaching £4,000 per year. And we have already had projections from the energy companies that this is going to move to over £6,000 per year during the course of the winter. So you're talking about, moving from just over 1,000 to around 6,000. So, it's doubled and then doubled again and then gone up some more by the end of this winter. So this is not affordable. UK households cannot afford these costs. So we can talk in a moment about what that means. This is UK natural gas. Sorry, I'm glancing across to my left here because my main screen is on the left. UK natural gas futures. This has gone vertical. It's heading off the top of the chart. We've seen the prices going from somewhere around about 30, 40 pounds per unit, all the way up to where we are at the moment, approaching 500 pounds per unit. I think gas is, I'm trying to remember the unit that this is measured in. It's escapes me at the moment, a bit like the chart going off the top of the graph, but it doesn't really make any difference. You get the idea. We've seen the prices double, then double again, then double again. Look across at Germany, and this is important because Germany is the powerhouse of the European Union. We've always looked to Germany in the EU to provide the backstop, if you like, and the finances for the peripheral European states, countries like like Greece, for example, who country needed bailing out with a sovereign debt default several years ago, which we probably remember around about 2007, 2008, I think it was. And so if Germany's in trouble, then the rest of the European Union is in serious trouble, and the European project is in trouble. And the German PPI, Producer Price Index, has not just gone past the peak from the 1970s, it's gone past the post-World War II peak, which was the sort of apocalyptic peak that left Germany in tatters after World War II. So these levels of Producer Price Index are without precedent in human lifetime in Germany, and if that doesn't send a bit of a shiver down your spine, I don't know what would. An example of how precious metals react when things get out of control, this is the price of gold in Turkey, and just a reminder why people like to have a little bit of gold in their buried in their backyard or whatever, because when things really start to go seriously wrong, and I've got a couple of friends on holiday in Turkey at the moment, things go seriously wrong. You know, for us visiting Turkey, everything is dirt cheap, but for the people out there in Turkish lira, everything is completely unaffordable. In fact, Turkish lira is not accepted by the locals there now. It's all euros and dollars, and gold has gone up. I think it was 3,000%, something like that. It's gone up thousands of percent. Just looking at the chart there, yeah, nearly 3,000%. So incredible stuff there. Cotton. I mean, we've seen lumber go up, and lumber has come back down again. We've seen various metals, you know, shooting up in price, base metals, copper, and others. Nickel, I seem to remember, shot up earlier on in the year. But it's kind of, at the moment, it's a bit like the baton is being handed from one commodity to another. People are kind of expecting this sort of all-encompassing commodities bull run, but it doesn't quite work like that. You get these kind of enormous runs in one commodity or another, and the baton gets handed from one to the next. 1 minute it's oil, the next minute it's coal, then it's zinc, and then it's copper. And at the moment, cotton futures. So if you're expecting your clothing to get cheaper anytime soon, you can forget about that, because cotton futures have tripled in very short order here. And again, it's another example of a chart going parabolic. US inflation has broken out above a 100-year breakout line. That line has been in place, as you can see there, over the decades. We've moved from an era of US inflation rising and being supported by an uptrend line, as you can see on the chart there, to an era that we're all used to and we're all comfortable with, where inflation has been coming down, and that period has been defined by the resistance line pushing inflation back down again, and we've seen this downtrending support line. But we've just broken out of that and back in the process of back testing that breakout. So if this is confirmed, then this is something, again, truly historic in nature that's taking place, and it's an indication that we're moving from one paradigm to another paradigm, from one era to another era. The producer price index in Italy has gone vertical. The Euro area PPI, producer price index, has gone vertical. We're seeing the SPX and the NASDAQ rolling over. I noticed today, looks like it's going to need a parachute, because there's a bit of a hard landing coming from this one, because we've got a bearish rising wedge within a descending megaphone pattern, and it looks as though this is heading down at least another 25 to sort of 35% in fairly short order. Couple of quick charts to finish on. We've got the Bank of England CPI forecast, just to demonstrate how terrible the officials are at forecasting. Honestly, if I was as bad at forecasting in my 34-year career of meteorology as these guys are, I would have lost my job a long time ago. This chart it was done a year ago, and what it's showing you is the Bank of England's CPI forecast, and those kind of fan lines, those reddish coloured fan lines, they cover a range of possibilities. A little bit like I said right at the start, when you are forecasting the future, you have to acknowledge it's made up of a range of possibilities. Well, these fan lines represent the year-on-year change in CPI that the Bank of England said was possible a year ago. So the central dark red core of that is where they expected the CPI to be in terms of its year-on-year change, and then the lighter coloured sort of red colours are their lower probability outcomes, and that full range of reddish coloured fan lines covers their 90% probability spread. So what they're saying is it was 90% likely that this change in CPI would be between the upper and lower limits of that red shaded area, and then the grey box that's around it accounts for the remaining 10%. So it could have been below that, it could have been above that. So the entire probability range is made up of that box, 90% of which is inside those fan lines. So they're effectively saying that they're 90% confident that the CPI year-on-year change wouldn't be more than 6%, and that its absolute limit was 7%. Well, good work, guys, because it was nearly 10%. So it's three percentage points off the top of the chart. So it begs the question: either they're complicit or they're stupid, and that's another debate. This chart here is a sort of historical breakdown of UK PPI, and you could apply this to any of the European countries or to the United States, perhaps the United States in particular, because of the way this is comparing what's happening now to what happened in the 1970s. You notice the notes on the chart there referring to what sort of prices we faced here in the UK and how much they went up, and what we were talking about before we went on air with Pat as well. Don't worry, Pat, I'll let you get word in a second. which is that once inflation starts to kick in, if it's not transitory, that famous word transitory, if it's not transitory, then things start to happen. In other words, people start to notice the inflation, and they start to demand pay rises. And we're getting pay rise demands in the UK now of 6, 7, 8% that are being rejected. Okay, we're getting large unions and large organizations who are offering their employees 7 or 8% pay rises, and they're being rejected. And the country at the moment is coming to something of a standstill, as we're seeing large sectors of society. I think the barristers were the latest today to go out on a full strike, meaning that the legal system is now falling apart here in the UK, along with the education system, along with the street cleaning. They're also on strike as well. So we've got street cleaners out on strike. We've got doctors, teachers. It seems as though, transport workers, we've got strikes on the railways. And this is all very reminiscent, those of us that remember, and I'm not quite old enough to remember clearly, but the 1970s followed a similar sort of blueprint. And again, it was kicked off by an energy crisis, and it was the Yom Kippur War, where the Arabian nations suddenly overnight put the price of oil up for certain countries, including the UK and the US, by 17%. Now, the causes of the oil rises and energy price rises this time around are somewhat different, but the net effect is very similar. And we're getting very similar echoes of the past starting to take hold. So those wage increases are going to start feeding back into inflation, of course. And we talk about adding zeros to everything. So we're not any worse. Most people, if you think back to the 1950s, 60s, 70s, compare the standard of living then to the standard of living now, we don't have a worse standard of living. People, the sort of working class, if you want to call it that, have a more comfortable, generally speaking, standard of living. But it's not that so much that is the issue here. It's the way that we're hyperinflating or edging towards a sort of a hyperinflationary event. That's the risk, and that's the problem. Because what happened in the 70s was a sort of well, of course, the US had just come off the gold standard then, so that there's all of that to do with it as well, and how the US dollar and currencies around the world began to sort of interrelate and the sort of found their market values, if you like. But all these years later, 50 years later, we're now getting to something that's slightly different. There are, as I say, echoes from the past, but we have some serious issues that bear thinking about and bear examining. And this is sort of one of them. I've called it the elephant in the room, and that is that we have a situation where, and this is US government bonds, it's the 10-year yield. And the 10-year yield has been declining a bit like those interest rates over the last sort of 4 decades, 5 decades. But it's now starting to break out, and interest rates and inflation are breaking out. The elephant in the room is how does this square with the weight of debt? We're talking about, whatever it is, over 30 trillion of government debt in the United States, not counting the unfunded liabilities. So as yields break out and as inflation breaks out, what is that feedback going to bring to the system? How is that going to relate to the ability of countries, Western nations, to service their debts if yields are that high? What starts to break down? And I've referred to that line, that sort of resistance line that we're just breaking out, as the pain line, because I'm not an economist and I don't really know what those effects are going to be. All I know is that it's going to be painful for the system. It's going to be painful for the economy. It's going to be painful for the nations to meet those debt repayment obligations. So there is a big elephant in the room here, and it's just what the ability is to raise rates in order to try and cool inflation. How much do rates need to be raised in order to cool certainly what here in the EU and Europe is now turning into runaway inflation? Even the Bank of England has admitted that we're moving from 9 or 10% inflation in the UK now to over 13% inflation by the end of this year. So that is starting to get seriously worrying when we've got interest rates down at sort of 0.75 to 1.75% across various European nations. So we've got very low interest rates, of effectively 0 to 1%, 2%, and inflation is getting away from that. The last time we had these inflationary numbers in the 1970s, it's 1973, in fact, and interest rates were at around about 9%, whilst inflation was just a little bit higher. And we're nowhere near that today. We're down, as I say, near to 1%. So there's something not right, and something is going to, I think, break. And I've summarized all of that in this chart here, which just sort of compares the 1970s with today, and just kind of repeats some of the things that I've just said, that we have entire sections of industry sort of grinding to a halt, falling apart. We've got large swathes of society that are beginning to suffer very, very badly, and large sections of society that are set to suffer the same sort of fates and consequences as we saw in the 1970s. But the difference between the 1970s and today, as I said, double-digit inflation is not being matched by double-digit interest rates. So, make of that sort of what you will. We no longer have the ability to lift interest rates to 10, 15%. Clearly, it's mathematically impossible. So, so that's those are the charts that I wanted to show you. They're pretty devastating in terms of their sort of the verdict that they deliver on our system as it stands at the moment, and pretty damning in terms of what we might expect to happen next.
Well, number one, thanks for sharing that. That is a lot of really good charts that you shared right there. A lot of good information. Now, I'm gonna ask some questions about all this, and maybe we know the answer, maybe we don't. But what is driving this? What do you think is the driver of all this? Is it a shortage of energy? Is it a inflation problem? Is it the debt problem? What do you, or is it a combination of multiple things? What do you think's driving it? And the reason I ask what's driving it is because if you can figure out what's driving the issue or problem, then you can monitor that as a leading indicator. So we're seeing all this evidence that something has changed, a paradigm shift, an increase in inflation, an increase in debt, an increase of currencies, an increase of all these things. What do you think the driver is, if you were to try to pinpoint it to something?
You want me to handle that one, Kev? Or you?
Yeah, go on, Pat. Go on. I've spoken enough.
No, that was fun. I was just sitting back enjoying you talk, Kevin. It's like it was candy to my ears.
I feel like a complete sort of party pooper here, and a sort of harbinger of doom. But anyway, yeah.
Well, I'll tell you what's wrong with your question, Andy. It's a good question, but if somebody tries to attempt it, that means they know nothing, because it's going to be an aggregate of all these things. It's like, I do have an answer for you, so I'll circle back to it. But to try to figure out what exactly it is, it's a combination of everything, right? It's a combination of debt, of Euro USD, those lending rates. It's a combination of cycles, pendulums, bigger tidal waves. For 10 years, a bull era growth stocks. For another 10 years, it's going to be inflation-related stocks. It's all these things put together. And the one chart that I spotted that really summarizes the war between the fight for the money supply. So even if the money supply goes up, it's not the money supply going up that's driving anything. It's where that money supply is going. And essentially, it's the SPX chart, or Dow Jones, divided by the producer price index. Essentially, that chart has been like a Rosetta Stone. And whenever that thing has broken down of beautiful, beautiful rising trend lines below their 7-year moving average, like whatever you want to do TA on it, that has changed everything. Everything behaved differently once you're below that line or above, depending what you want. So let's say you were long gold and minor stocks. If you weren't long gold and minor stocks when the PPI had broken out versus the SPX, then everything went wrong for you. Good news was bad, was priced in as bad news. And it's like everything was flip-flop. And the same news that probably came out for gold and silver miners, if it happens at an epoch where the PPI has broken out versus SPX, oh, great news. And then the price goes up. So those capital flows, for me, it's super easy it's until I see another chart that for over 100 years, these cycles have been repeating. It's US equities, growth stocks, when they hit the inflation wall, so as defined by the producer price index, which is less, or I don't know if there's any hedonics adjustment to it like the CPI, whenever those trend lines have broken down, the rules of the game have flipped. And that's probably the biggest problem people have right now is people who, let's say they're long crypto, whatever, and they don't see that this has happened, that the cycle has flipped scripts. So whatever recipe they had for the past 10 years was working, now they don't understand why it's not working anymore. And the good news that they used to have is not being giving them the price appreciation in their growth stocks, is because the flip has scritched. So what is a producer price index? Well, it's input costs. It's even, I think, labor costs. It's a whole bunch of stuff that goes in, what it costs for the producers to produce the goods that everybody's consuming, right? And so that's for me what I would, as an aggregate, whatever is computed in that index, a producer price index, that would be what I'd be keeping an eye on. And for US equities, some people say, oh, well, Patrick, if US equities are going down versus price index, doesn't that mean that gold, silver, energy are going to go down? Look, the SPX has 8 or 9% of basic materials and energy in it. So even if your energy stocks go ballistic, it's not going to be enough to keep the SPX afloat versus inflation. Maybe towards the end of the cycle, when maybe I don't know what's going to be the high watermark in the SPX, the weighting, maybe one day energy is going to be 20%, it's going to flip the script on the now it's tech stocks, it's services, it's a whole bunch of stuff, right? And that cycle has just started, Andy. So that's my answer, my final answer. It's producer price index.
Yeah, the way I've always viewed it, maybe I'm viewing it incorrectly, is you usually have an inflation, like a currency go up in terms of quantity, like lending goes into existence, and it kind of spurs or triggers another event. It usually puts oil into a shortage, so to speak, if you've got more money in the system chasing all these goods. And oil is the driver of GDP. But if you have a constraint in your oil or your energy source, then everything goes out of whack, so to speak. And it basically transfers the money in the system into inflation or CPI numbers, the consumer price index and producer price index numbers. And you just showed a bunch of energy costs literally going vertical, which would mean that your producer price index and consumer price index would go vertical with it. Do you think there's a problem with our energy delivery, or do you think there's a problem with energy that we won't be able to get this back on track? Or do you think it's a solvable problem? And if it is a solvable problem, how quickly do you think we could solve this?
I want to go, Kev? I have a technical answer to that. Maybe Kevin's going to put some color.
Well, I was trying to figure out whether to answer this sort of fundamentally or technically.
Because I have a chart for you that it's easy. The market's going to figure it out.
Well, from a technical point of view, we had this base where we had a historic kind of norms, if you call it that, a range where you'd expect natural gas, electricity prices, oil as well. But what can happen during these events where stuff gets repriced is that you kind of break out, you get this vertical move, and then it'll come back down and it sort of back tests the level that it broke out of, and it finds a new plateau. So what we're likely, I think, to be doing here is seeing this this vertical move in energy prices. But I do expect it to come back down, but not back down to where we were, but to establish a new sort of paradigm, a new sort of staging post. You wouldn't expect, after all, you wouldn't expect energy prices to be permanently capped at this kind of trading range. You would expect over time, as money supply increases, that everything, whether it's oil, whether it's the price of a can of beans or a loaf of bread, they all go up at, broadly speaking, similar rates. If you look at commodities since the 1970s, and you look at a range of things like clothing, automobiles, housing, they've all trended upwards, admittedly at varying rates and varying degrees as the capital flows shift from one to another. But so therefore energy is just part of that. And there's no particular reason to expect energy to come back down to the levels that it was 10, 20, 30 years ago. But these incredible, rapid overnight increases are, they're a total shock to the system, and the system can't handle it. Something is going to break apart here. I mean, we're talking in the UK about the government having to step in and bail out 60 million people in the UK and all of the industries by paying for their gas and electricity bills. It's going to cost more than COVID. It just seems like every time something comes along, the answer is, oh, let's print some money and give the money to the public so that they don't have to pay their bills. Well, what kind of long-term solution is that? So yeah, the similarities with the 70s are quite striking as well. The energy crisis element of what happened in the 70s and kicked off. And this is what I'm interested in as an investor. What happened with that energy shock in the 1970s is it kicked off a shockwave through the system, as it's doing now. And that shockwave in the system led to stock markets falling and not getting back to where they were versus inflation for 20 years. The SPX took 20 years to get back to where it was, inflation adjusted. And that is why commodities and precious metals did what they did in the 1970s. For the first half of that period, so the SPX losing to inflation, and then it started to recover and recover and recover. During that first 10 years of that 20-year period, during the first 10 years, that was where commodities and precious metals went on their historic bull run. And the question is, are we about to see the same thing again? Are we about to see a 10-year period where commodities, energy, precious metals go ballistic, and then it takes 10 years after that for the SPX to get back to where it was versus inflation? Because if we've got 10% inflation now, 10% 30 in the UK, 15% next year, then another 10%. You can easily imagine, the compounding effect of inflation and just how long it's going to take for SPX to get back there if it continues to break down. So that's as an investor, that's what I'm interested in.
It's you could visualize that on the chart. I could share my screen. You could visualize what Kevin just said. It's just look at the ratios, guys. And ratios, they're supposed to oscillate up and down within a range. Let me okay, this one here.
I'll just make a quick comment real quick. The 1970s, we had an energy shock in America, and it was only America driven for, I'd say, the run towards gold. I think now it's a global energy crisis. Well, so if that's the case, you're going to see a much larger money flow towards, I think, solving these crises, or the crises that are created around the world. It's going to be a worldwide problem, I would think.
It was worldwide in the 60s and 70s, Andy. Inflation was the same chart. If I pop up the UK inflation chart from 1940, it's the same one as the US practically. People
it was. I think the European nations fared a lot better, actually. I think
if I put the PPI of those countries, I did that a little while back, and everybody had inflation spikes during the 70s. Italy had some. They all had some. It's not just you related to the US. This stuff is worldwide. Even before the era of technology and computers and algorithms, this stuff, there were worldwide phenomena, even in the 70s. But we could cover that chart after there. So I don't think there's going to be much of a change. So that's where charts, and that's knowing that even in the 70s, there was a strong link of all this inflation that was worldwide. Whatever's happening in the UK now and those charts, you could also almost see them as crystal balls to what probably could happen in the United States and Canada, right? Whatever's happening there, the chart showing it's not crashing down their gas prices, it's going up. So we have to look in the same direction that they went. But let's go back to, like, let's say Kevin's racial charts. This is gold. No, this is SPX divided by oil. So let's say use oil instead of PPI. These are cycles, and it's pretty much, there's like a range with these crazy spikes here. So if this is spiking up, that means that it's SPX going in bubble mode versus oil, right? That means oil is so cheap versus all the money sloshing around. It's going in the dot-com bubble here. And here was the nifty 50s in the 60s. Here it was the the great run there, 1929 there. What was the name for that bubble in 1929? Did they have a name?
Well, they had a huge housing bubble in the mid 1920s.
But did they have like a name, like
what's the name of it?
A fancy name, or the Roaring Twenties?
Yeah, Roaring Twenties. Yep.
Yeah. So high water mark. So that means of all the money coming in, SPX got distance itself from the energy cost. No matter whether oil is $1 or $2 or $100, wherever it is on the chart, doesn't matter. The ratio is 2 to an extreme. So here's an extreme. Here's a 60s extreme. Here's the 2000.com bubble, and you'll see it's a spike, but the majority of the price action is below. It's pretty much on par with the previous, but it's still spiked up. So energy cost, dirt cheap versus SPX. And here, look at the insane spike in March Madness. We're probably, I don't know if we're ever going to see this again. You know, it's going to be, the way I see this right now is energy, whether it's $80, whether it's 160, whether it's 300, it's cheap. It's cheap. So from all the money flows, from all the money right now, the SPX has had too much of that pie, and now it's a pendulum swing all the way back down. And these pendulum swings, they take 10 years to unfold. So right here broke down, and it took time for, and this is, okay, some more details. There's a pendulum swing that creates a higher low. And then after that, there's another pendulum swing that goes all the way up, and that creates a mega pattern, which when that breaks down, you have a full pendulum swing all the way back down. And that's like a 3-to-1, 2-to-1 SPX to oil ratio. And some people calling me nuts. It's impossible, but the chart's done it once, twice, 3 times. And right now we've had a higher low. So I think the 2000 run was just a warm-up run. It was just the first pendulum swing down, and it hit that congestion area right here. And now this breakdown line is probably going to lead to a test of this major cycle breakdown line. And if that breaks down, then this is where energy goes ballistic in favor of versus SPX. But it's just a ratio, guys, right? So this ratio, this chart is highly inversely correlated to oil since 1973. Before that, it was SPX driving this chart. So that means here, oil was practically not moving before 1973. And after 1973, it's actually the oil price. So if this goes down, it's not that oil is going down less fast than SPX. It means oil is going up, and SPX could be going flat, sideways, up, down, doesn't matter, right? If SPX is going up while this thing's going down, that means we're like in a inflation or hyperinflation type of a scenario. And the 3-to-1 ratio, the target here. So let's say SPX is 4,000 by the time we hit the bottom here. So do 4,000 divided by 3. That's your target for oil. I don't know if it's going to be 4,000. Maybe it's going to be 2,000 in 10 years, SPX. I don't know. Because in these cycles, we know that SPX by the 2001.com bubble to the 2008 bottoms, did it go down half? It went down 50%, right? Or 60%, I think even. So if we're 4,000 now, SPX could be, easily 2,000 by the end of this. So 2,000 divided by 3, it gets you about a $700 oil price, which I know some guys, they say it's nuts, but it's in 10, 20 years, guys, or 10 years. It's not, it's just a number, guys. It's just, they're just adding zeros. But as traders, investors, you just want to be on the thing that's adding zeros faster, right? It doesn't matter nominally. I totally don't care if oil's priced $1,000 or $50. It's this ratio that I care, because whatever the price of oil is, when that ratio hits down here, that means whatever it is, it could be $5 or $1,000. That means oil is too expensive and the system breaks. You know, when people say breaking points, it's going to be a spike here. It won't last long. You know, look at these spikes or these bottoms there. They don't last a long time, right? But we'll be getting out. So that's my speech on that. Use ratios.
So here's some other things I'll throw out there. We've always had plentiful energy through that entire cycle, looking backwards. Looking forwards, do those same conditions apply? Do you think that the world can bring on energy like it could in the 1970s? Because the 1970s, what I meant by it was America driven. The energy crisis in America of us hitting peak oil and then rolling over, I guess, propagated through the entire world in the financial markets. Now it's the global energy system, I think, that's struggling to keep up. I know Russia kind of maybe perhaps started this system, and we know that it started before the Ukraine-Russian war. which means other people knew it was going to happen before it, or you could view it maybe differently, that the things were in place and Russia decided to purposefully do it at this time because it was going to have the maximum effect. But do you think looking forward that the markets have that same type of access to this energy out there? Because I mean, I'll just kind of quote it. You said that it was going to be a temporary spike, but that temporary spike was because we've had plentiful energy everywhere. We could just mine more coal. We could get more natural gas quite easily. We could tap into new oil sources and whatnot that were still cheap. Do you think that paradigm has shifted? Because when we look at the charts, we're looking at 100-year-long downtrends breaking to the upside in that inflation figure that you showed in America. We're seeing these very large structures that were created breaking, like these big, long basing patterns and whatnot. Could that be an indication that we're at the end of cheap energy and that the paradigm will completely kind of shift? And if we get that shift, I know there's a couple of questions in here. And if we get that shift, money is going to have to flow to solve these big problems. And I know you have the SPX to oil ratio chart there. If we have energy go up dramatically, I would think that the stocks that are energy consumers would drastically go lower, because just like Europe right now and the UK, I don't know how businesses are surviving with energy input costs that expensive. I think they would collapse. So you've got these big long-term pictures. What exactly is this thing painting? Is it telling us something deeper with a problem in the system, perhaps?
There is a multiple problems in the system, and by the way, what uses quite a lot of energy to produce cryptocurrencies, what has just dropped by about 80%, cryptocurrencies. So we haven't touched on those, but they're pretty much a tech stock until proven otherwise. We mentioned that before, and there are some insanely low targets for Bitcoin that I've been looking at, which people can find on my Twitter feed, which are speculative at this point. But if some of the things that we've been talking about do bear fruit and come to pass, then it makes a certain amount of sense that some of these very, very low destination targets for cryptocurrencies come into view. And of course, the multi-billion-dollar investments in cryptocurrencies, it wouldn't take very much of that to flow into commodities and gold and precious metals to have a noticeable effect. So that's something to bear in mind as well. But going back to the question of energy, we have the answers. The answers are out there. I mean, for example, domestic energy, modular nuclear power plants, they can be built in 3, 4, 5 years and be up and running. We're getting quite a few of those now being built here in the UK. Rolls-Royce are heavily involved in development of these small modular nuclear power stations that can each power station can provide enough power for an entire state in the United States or an entire region of the British Isles, several millions of people. So the answers are there, and if we're prepared to accept nuclear energy in a way that we haven't done up until now, or some countries haven't done, that's part of an answer. Obviously, the green agenda has caused probably as many problems as it's attempted to solve in terms of policy. I'm not really going to go there because it's quite a political subject, and there's a lot of heated debate about the problems that has issued. Obviously, me as a meteorologist, I do realise that we need to do something to look after the planet, but it's very problematic when you try and do it so quickly and you suddenly stop trying to use coal and fossil fuels and so on. And in fact, it's had the opposite effect. And I think we're starting to see more people burning stuff across Europe than has probably happened for a few centuries. I think everybody's chopping trees down to try and get enough wood in their backyard to keep them warm through the winter. So that's kind of backfiring big style. But technologically, I believe we do have the answers, but I think we've got a very, very rocky 10, 20, 30 years to get through. I don't think the next decade, 2 decades, 3 decades are going to be as relatively calm and peaceful as the last couple of decades have been. We've seen we're seeing stability in Western democracies, generally speaking, for the last 50 years. And that stability is going to be hard to keep a hold of.
I saw one time a chart of, I think Tavi Costa put out a chart. It was mining, exploration, investments since 1980. And it was just going down. But then my reflex is, well, of course, it's looking just like the interest rates going down. So as interest rates, the 10-year yield has been going down, people have rather borrow money and do stock buybacks and whatever they want to do in a low interest environment, right? Expand the price to earnings, whatever, all that stuff, and not use that capital to, to create machinery, to do exploration. So to circle back to your thing, Andy, I just think the timing, the issues of energy, whether it's in the oil, in the ground or not, just the fact that we're not ready for the turn is going to create higher prices just for the market to say, okay, you're not motivated enough to get more oil. Okay, price up, until the price is high enough where everybody's motivated. And we've been drilling and doing R&D and putting nuclear plants online for 5-10 years. And then when everybody thinks, oh, the future is nuclear plants, then that's when the price stops. And we're out because we got in early before all that stuff unwound, So I think it just happens that because of all this, the capital flows have not been going in stuff that's real, and it's just like a natural effect that is gonna take time for whatever supply and all that stuff to offset the price increases. 10 years, like most of the charts, they're showing us 2028, 2032 of price increases in commodities to really motivate people. And you know how it is to motivate them. Fair value, we might pass it by in 5-6 years. But then we're just going to, because of the pendulum always swings stronger in one direction, then we'll get melt up parabolic end games that will be above fair value for commodities. But that's probably going to be in the final couple of years.
And here's another question tied to it. We talk about the energy crisis. We talk about some time frame for it to be solved. Do you think the debt and currency of these countries can be resilient enough to last that long through this type of crisis?
Yeah, speaking whilst the euro is crumbling towards zero at the moment, isn't it? So some of these currencies, I mean, the European project, the Euro project, is a bit of a unique case. And of course, we had Brexit a few years ago, and here in the UK, we left the European Union, and all sorts of reasons for that, and different people had different reasons, but one of them is the fact that we have to answer to the European Central Bank and to Brussels every time we want to make some spending decisions. And the whole European project is apparently sort of unraveling at the moment, and I'm kind of glad that here in the UK we're not tied to the euro, because the euro is in some serious hot water here, and with the way things are going in Germany and what's happening financially across the European Union at the moment, I've got some grave reservations about whether the euro is going to survive without some very, very heavy intervention, what form that might take. And of course, we've got the whole issue of digital currencies bubbling away in the background as well. European Central Bank digital currencies, Federal Reserve digital currencies, the digital dollar. I'm quite sure that will be thrust upon us at some point, and how that system would work, I'm not entirely sure. So one way or another, I suspect our current sort of monetary system, our monetary regime, and of course the US dollar as global reserve currencies, clearly its days are very, very numbered, with the BRICS countries circumventing those payment processes. So our entire global monetary setup, our entire global monetary regime is going to probably be fairly unrecognizable 10 years from now. But I don't have a crystal ball. I'm not. I can't say which currencies are going to go first. I say the euro is vulnerable. The US dollar is going. The DXY is going vertical in nominal terms, but you adjust that for inflation, even that's not looking too impressive either. So you know, I suspect the US dollar is in its final hurrah before it collapses in a pile of burning ashes. So that's probably about the best way I can summarize that. I don't know what Pat thinks about it all.
Yeah, well, I could show you. I have another chart just to show you how close we are to implosion point.
Yeah,
I'll do it again. I'll share you this one here. Okay, share. You guys see this one?
Yeah, it's coming on the screen now. Yeah, it's there.
Yep.
So this is I call it my system debt serviceability saturation chart. So it's just I just multiplied the total public debt by the Fed fund rate. So the logic was, if ever those two numbers, whatever they are, low rates, high rates, low public debt, but multiplied together, you create the atomic bomb that is something that cannot be serviced, right? Or not serviced. But here's where we are today, guys. We're back. Here's the line here. I'm up here, same levels as before this thing started unwinding in late 2018, same level as 2007, 8, same level as the dot-com bubble. So before it was low, so the saturation levels were lower and they had cleansing cycles back to low levels, but this has been climbing up and up. But there's still every recession, and look at that, every single recession is the cleansing cycle. Every single time these lines have been broken, it's either the Fed fund rates go down or the debt goes down, but those two multiplied together create a smaller number on this chart. Here you see another recession as this drops, another recession, here another one, the 2001. And that's where we are today. So I don't know what your black swan is, Andy. Do you have like a top 3 black swan events that you think could happen? But it could happen anytime, because when I look at this chart, I think honestly it's just going to be the market going down 10, 20, 30, 40%. And like Kevin's Bitcoin chart showing that, I just think it's the market's just practically like unraveling that's going to create the Fed to lower the rates. Because look at that. Back, and this is when gold topped, right? And commodities topped. Why are they topping? Well, the total debt saturation was at 1970s level. But Patrick, the debt's so high, gold should be rocketing. Well, in this viewpoint, because the multiplier, the Fed fund rates went back down, I don't know, to super low levels back in there, multiplied by the debt that was there, it was sustainable. It's like, that's why we have to look at ratios, or we have to look at multipliers to see what are the high water marks that a system could support before it implodes, right? Because just looking at numbers, people, the debt's so high, it's so high. But okay, well, who cares? They're adding zeros again. It's just numbers on a scale. They're adding zeros. So you have to see it in relation to something else, and then you see breaking points. So here, look, that was the total top for gold, silver. Here, as this unwound in the 2021, 2020, even gold and silver peaked, right? In August, September, right? All that stuff peaked. But now it's a full reset. So they're going to have to do something. I don't look, if they raise the rates again by a point, 1%, you multiply it. So this is a multiplier. It's the percentage of the Fed fund rates times the I don't even know where it's going to go on this chart. So they're going to have to multiply the debt times the Fed fund rates. I'm going to go, maybe there's a rising trend line here, Kevin. I didn't see, maybe, right? A megaphone. Maybe this is not the level, but it's extreme. It's very extreme. So we're much closer. And all these were important bottoms for gold, silver, and all that there. So that's my market implosion chart. And it's close. It's super close. What do you think is going to break it? Andy, do you have like, let's go down conspiracy, like anything fun? I want to hear new stories.
I think interest rates are not necessarily maybe controlled by the Federal Reserve. I think that the market's going to force things that it doesn't want to do. I think it's already doing that. And I think energy is the driver of it. So if energy keeps piling, if energy is scarce and we have a restraint in energy worldwide, I think that the currency in the system is going to start to rotate on them to energy and commodities, increasing the price of those and increasing your PPI and CPI. And even if we have a recession, the supply of oil could go down faster than the demand is being destroyed increasing the price even through a recession, which then we have to even kill more demand. So I think the problem is in energy. And I think that, at least my take on it, and that energy is going to be the mechanism that transfers the currency in the system into PPI and CPI, which then puts bonds at a real big negative rate, real rate. And then the bondholders are just like, this can't sustain. Let's sell it all, sell it all. And then you're left with one buyer, which we're seeing already, which is the Federal Reserve, buying all the debt to try to keep the interest rates at a normal level, so to speak. We're seeing it in Europe too. That's what the fragmentation and all that stuff is. So I think if energy comes out full force, and if let's say Russia and some of these other countries want to use it as a weapon, like a currency war, so to speak, I think they could bring all of these countries to their knees by just saying, I'm not going to ship oil. And it's going to self-decline anyway when you take the Western countries out of Russia, which is they've got all the technology to basically lift all this oil out of the ground. It'll naturally decline to a state that they are technologically capable of lifting it out of the ground. And if China jumps on board and they squeeze the GDP, we'll call it, well, they squeeze the inputs to these manufacturers around the world, you've got declining inputs of what you can buy at the same time that you're squeezing the energy. That's not a good mix. I think it's going to destroy economies, I think. And I don't know. I think you're going to start to see other countries start to demand commodities for commodities, and they're going to start bypassing fiat currencies, perhaps. Yeah. I don't know. That's obviously hugely speculation there, but
it was around about a year ago when I started noticing the energy prices breaking out across Europe, and the natural gas and the electricity prices started to look unnaturally high, breaking out of those levels in a vertical kind of fashion. And it was when that happened that I started looking at the PPI and the CPI, and my kind of logic was, well, you know, if these energy prices remain elevated for long enough, okay, if it's a spike and it goes straight back down again, okay, it's not going to really feed through into anything. But my post at the time last year was basically saying that if we've now developed a new baseline for energy levels and it continues to move up and just maybe back test and gets back down to the previous historic high, and the historic high is now the new low, then my sort of concern was that we stay elevated for a long period of time and those costs feed through into the PPI, and then producer prices feed through into consumer prices. And you know, that was a year ago. Here we are today, and we're up to our neck in serious trouble here in Europe, because everything has gone up now. Energy has gone up, PPI has gone up, CPI has gone up, food in the shops has gone up. Everything is going up at 10, 20, 30%, and everyone's aware of it now. So that what you just described, Andy, is what has happened here in in the UK and across Europe. So, and the global nature of stuff, as Pat said, in the 1970s, there was a strong global element to what was going on, but the global interrelationships have matured since then. And China now produces everything that we see around us. Sitting here in this room, probably all the furniture, the computers, the light fittings, the electronics and the screen that I'm talking to you on, they're all from China. So China, it puts us in a bit of a tricky situation, because if China turns out to be bosom buddies with Russia and starts to sort of cozy up with Russia, then how's the West going to react to that? And what sort of leeway do we have to react to that? Because it's not as if we can suddenly say to China, well, sorry guys, we're not going to do business with you anymore, because if we do that, talk about sort of shooting your own foot. That we'd be signing our own death sentence if we said that. So China and Russia and the BRICS nations kind of have us over a bit of an unfortunate barrel at the moment, and it's a position we've kind of put ourselves in.
I had an idea, Kevin. Let's add a B and a C to the BRICS, another C and a B, so we get Britain and we get Canada, and let's join these guys. Right?
Well, at this point, we need to start thinking outside the box, Pat. Otherwise, we're
man, it's time. It's time to. I'm pro China. Whatever what did I say? I'm getting banned. Oh, I got banned. Sorry. Well,
Well,
look,
you joke about it, but I mean, you only go back a few years, and it was official policy to be as close partners as we can with China and Russia, which has kind of backfired. That the regimes are not good regimes in terms of their human rights policies, and they just are not societies that operate in the same way that we do, and they're kind of incompatible.
hold on, Kev. You don't have our prime minister. You don't know how it is in Canada now.
Good point, Pat.
Sorry, Andy. I don't want to get you blacklisted on YouTube.
We're going down into the realms of politics here, but you know what I mean. I mean, it's a very different political system there, and it's a very hard square to circle. We either turn a blind eye to everything that we see as human rights injustices over there, and let them make our cheap stuff for us, or what we try and turn them into a society a bit like ours. Well, that's never going to work. So here we are in this mess.
I do have one last question for Kevin, because I know you guys are kind of going through the crisis right now. What if you could go back 1 year from now and prepare for it, what would you have done differently, or what would you have done the same to prepare for what was potentially coming? Because it may come to America and Canada, and it may or may not. I don't know, but how would you have prepared differently?
Best advice: if you can get yourself off the grid, off the power grid, then that has got to be the first thing that you can do. So whether it means covering your entire roof space with solar panels, whether it means geothermal energy. I know there are a lot of systems these days where you can tap into the underground heat sources and have sort of geothermal heat pumps to heat home and that kind of thing. I know they're quite expensive, but by the time you you just pay for them monthly, and believe me, it's probably going to be cheaper than the gas and electricity bills that most people here are going to be facing. So if you can find cheap alternative sources of energy that mean that you don't have to be paying the energy suppliers, then that is going to be an advantage. And if you go down that route, then you're probably thinking about having a little bit of outdoor space where you can grow your own plants. You grow your own fruit and vegetables and that kind of thing. Depends what kind of climate you live in, but the more that you can be self-sustaining, then the better, because the costs are crippling now across large parts of Europe. Whether it's food or energy, people are being put into abject poverty because they just cannot afford the prices in the stores, and they can't afford the bills to heat the home. So whatever opportunities you have to minimize that requirement, then that has got to be a good thing. If you can do that, do it. What have you got to lose? It's a win-win situation. So it's a good way to invest if you spend a few $1,000s getting yourself a little bit more independent.
Okay, well, that's all the questions I have. Is there anything else you guys like to add? Anything else?
Just I'm a glass half full kind of guy, so don't take away from this that I'm just a constant harbinger of doom. But I'm also a realist, and I can see the technical analysis charts there. They act as a kind of a bit of a guiding light as to where we might be headed, and it's better to prepare for the worst and just hope for the best. That's probably how I would finish.
Yeah, it's not the end of the world, guys. It's like hopefully you're giving value for your audience, and we try to do the same thing. Maybe we have overlapping audience, but people have to understand now the ship is turning. It's taking 1, 2, 3 years. That's what's shown me. Like it takes about 2-3 years from the first moment that gold breaks out on its own chart, like in June of 2019, and by the time it breaks out versus the SPX, 2-3 years could go by, and we're in the third year now after gold broke out. So it's unraveling now, right? The US equities, they're below their 200-day moving average. Bitcoin has dropped off, so the turn is happening now. Either you hang on to your old techniques of investing, or whatever you used to love and always hope that you could catch whatever Facebook and all that stuff, or you understand that you have to go down the energy path, commodities, and that's where you'll be able to fight off inflation, right? Because this is critical in a disinflation environment. If your performance on your portfolio doesn't go up too much, it's not that bad, right? The cost of living, but now it's crucial, because now if you can't beat inflation, it's higher now. The watermark, right? You got to beat inflation, or else you're going to get destroyed. And this is tough because if people don't have savings, they don't have enough money to put in energy, then they're going to go on leverage, and then their sell stops will be too short and they'll never make it alive. It's super sad because people had to be saving up their money. I don't know, unless they were able to rotate out of the growth stocks before everything like goes down more and try to prepare for the other. It's tough. The turns, they're like choppy waters in the ocean, man. They'll rip your hull to shred if you're not built for it. Sorry, that was dark.
That's really.
And it's the truth. That's what's happening right now. People are always looking for direction, but it's a turn. This is a generational turn unfolding before our eyes. It's happening now.
We've mentioned it a few times. The ratio charts are really key to this. You know, don't just stare at a chart of something in isolation. The ratio charts allow you to compare one sector to another and to measure the price of one thing measured in another. So you can measure stuff in the price of oil, or measure it in the price of gold. Just measuring it in dollars doesn't give you a true picture when you've got such high inflation levels. So use ratio charts. If you're trying to decide whether to invest in SPX or commodities, well, pull up a SPX to commodities ratio chart. It tells you exactly what Patrick just said. The ship is turning. That, you know, we're carving out an arc in SPX to commodities, and we've been coming down and down and down. You know, commodities have been losing to the SPX for year after year after year after year, and we're turning a corner. And this chart is projecting up and up and up and up into the future. So as long as this chart holds, as long as the support line holds, we're now seeing this ship turn towards commodities and away from general equities. So just keep an eye on those ratio charts.
Yeah.
And then one last question. It's going to be super short. What's your favorite commodity?
Uranium.
What about you, Pat? What's your favorite commodity?
Yeah, well, Kevin's pretty much convinced me, because all these uranium to ratio charts it's kicking everything's butt pretty much and has huge potential. So I do love silver and all that, but even right now, uranium's breaking out versus, let's say, silver junior miners and all that. So you got to go with who's hot.
And an honorable mention for platinum, because platinum is historically undervalued to gold and silver. It's not turned yet, it's not broken out yet, but when it does, watch out.
Yeah, guys, we're all gonna look like geniuses when all these commodities start popping up. You know, we're gonna see Andy on CNBC soon. You know it's coming. You know it's coming, Andy.
Yeah, you chose a couple of commodities that are also my favorite: uranium, platinum. I like natural gas a lot, and oil. So
yeah, if you'd allowed me a choice of four, I probably would have chosen those four.
Yeah.
Shooting darts at a dartboard in a bull market, we're all gonna look great.
Yep. Yeah. Everything's going to come up. So, yeah. All right, guys. So if somebody wants to reach out to you, how do they reach you? Twitter, go to your website. It was North Star Bad Charts.
At North Star Charts for me, at Bad Charts 1 for Pat on Twitter. And our website is northstarbadcharts.com.
All right. Well, I thank both of you for coming on. Really appreciate it. And we'll catch everyone next time.
Thanks, Andy. It was fun.
Andy.
Ciao, man.